going to take a few minutes to talk about kind of some things that happened last fall and to tell you what went on. I mean, obviously we had the government shutdown in October that had some real some consequences for our business. They weren't as serious as they might have been. We were down for 2 weeks. We didn't have market information. There was no disruptions of animal flows. An important thing because inspection services had been deemed to be essential services a couple of years before. The government stayed behind that. If you'd have had some problem with inspection so that you couldn't operate packing plants, which the law says you can't operate a packing plant without inspectors, that would have been obviously a far more serious situation than it was. We didn't have a lot of what we thought was I termed gouging. I don't think we had a lot of price shenanigans that went on during the time period. Most people said, okay, this isn't going to last long. We're going to trade hogs or trade cattle or whatever at the price, the last quoted price we had, and kind of stayed with that for most of the duration here. They remained kind of stable at a time when they're normally going down. And so what we saw at the end of the 2-week period was our computations of packer margins were pretty darn tight when we came out of that deal because the meat prices had changed some and the hog prices hadn't, and we had some downward pressure for a couple of weeks. We had a big backlog of data at USDA, and they finally got worked through that. We've got all the details that we're going to get. There's probably no real consequence to that. When October of 2014 comes along, Ron and I and some others are going to be going, oh, gee, what do we do for year-ago comparisons? And what we're going to do is probably draw a straight line and take a point in the middle, and that's going to be the week or the couple of weeks we missed. Okay, so we'll extrapolate that data and figure out what to do with it, but we're not going to get much sympathy from anybody, I don't think. Most people there are some people used Urner Barry's yellow sheet. Urner Barry is a price reporting firm out of New Jersey that's been at this over 100 years. They're pretty good at reporting markets, but they don't report hog markets, and they don't report cattle markets. They're kind of meat and product focused. They're kind of the authorities on seafood. They're very highly followed on eggs and poultry, especially on the East Coast. Cattle Facts signed up a lot of new members during that 2 weeks to find out what fed cattle prices were doing. And so kind of the hole in this deal was hogs and feeder cattle. And we didn't have very good reporting. NPPC started the day that the government shut down. Of course, NPPC has producer members, which is the lion's share of their members. They also have packer members, the Packer Processor Industry Council that pays a voluntary checkoff into NPPC. And the producers, represented by the board of directors, and the packers talked to each other, I don't know, the day after this thing happened and said, boy, we're going to have something here. And we had tremendous support from the packers on an effort to get a voluntary system going that would provide some information to producers. We had packers representing about 90% of the barrel and gilt slaughter capacity in the United States that said, yes, we will report to a voluntary in a voluntary program. There was only one major packer that said no. We had packers representing about 85% of the total barrel and gilt slaughter that actually got us data during this time. We had one packer that was kind of mathematically challenged that never did quite get the data ready, but we were getting closer on that. And so they turned and asked me if I could do it. It happened that I was not traveling for a while there, so I could devote quite a bit of time to it. And I wrote the software to try to summarize this data and turn out some reports. It was decided early on we were shooting to do an afternoon purchase report and a prior day slaughter report using the same data that comes into USDA. Obviously there were a lot of concerns about confidentiality and some of those things that USDA does all the time, and we set up a secure website that packers could kind of Dropbox this into, and then I could pull it out and use it. We were ready to go kind of the day that they came back to work. But there were antitrust challenges here, and the challenges were the Justice Department takes a very careful view, and I'd say dim view, of trade associations gathering price data from their members. I mean, trade associations are by definition organizations of competitors. And so if they're gathering price data or supply data or anything else, it's a very short jump from there to price fixing. And so the Justice Department has taken a real dim view of that for a long time. As a matter of fact, the case law applicable here goes all the way back to 1920 in a case involving maple hardwood flooring. And in that case, the organization gathered price data, and if anyone got out of line, they wouldn't punish them. Okay? by trying to take away their market share. So it was a price-fixing scheme from the beginning. So you have to be careful. And there are three major conditions. One is that the organization itself shouldn't be the one doing it. They ought to have a third party, me. No one reporter should account for over 25% of the observations that goes into the piece of data, and that you ought to have at least 5 entities reporting each day. Well, the problem is in a concentrated business like the packing business, that the one that was going to catch us was the 25% requirement, because during the time that I was gathering data, we would never have published a report because we never had a day that somebody didn't account for over 25% of the observations that are in there. Now, this is a highly concentrated business. And so the other point about this, though, is our intention was to make that data public. We were just going to publish it. Anybody could use it. And we've talked to some data services, Urner Barry, EMI Analytics out of Fort Wayne, Indiana, that gathers a lot of chicken price data. And they've been told by the Justice Department that as long as they give the aggregated data to anybody who subscribes, that's kind of it. I mean, as long as they're not holding this confidential in some fashion. And so I don't know that we've got to jump over the same hurdles that NPPC would have had to jump over as a trade association. And so we've got to answer that question in case it ever arises again. But I don't believe we do, and I think we could publish prices. So what now? Well, we've avoided another shutdown. We were really quite concerned in October we were going to go through this again in January. CME Group does have to have a better plan. I mean, they closed the October lean hogs contract basically to itself. All right, that's what they used to close those positions in mid-October. And that's a situation that's pretty rife with danger. I mean, there could be a lot of games played there, and they answered those games by saying, well, we're going to have really tight surveillance so that we notice it. Well, the problem is their surveillance caught a few guys and stopped them from making trades that were legitimate in unwinding hedge positions. So I don't know that surveillance is the answer either. They need some things. Feeder cattle is probably a way bigger problem for them than hogs would be, because the source of the data on that is way more diverse, much more dispersed. Buyers and sellers, I guess I would really advise any of you, especially if you're doing formula price situations, talk to your packers, or packers talk to your suppliers, and kind of talk about what are we going to use if the government shuts down? How are we going to handle this? And maybe make a 1, 2, 3 list of alternatives there that you can. The system that we came up with last fall is functional. We do still have some questions on the legal, the antitrust issues, but should we have another government shutdown, we can react a whole lot faster this time than we did then. It'd probably take me a day or so to kind of get back into it, and I tried to document everything I was doing, but you know how that does when you set something aside for a while. It'll take a while to figure it out. But we had terrific support, and we got represented with some of the packers here, and they just were really good to work with. They were very helpful, and I really appreciated what they did last fall. So if you have any questions about that, I can answer, or I'll try to answer them, but I just wanted you to know what went on. And it was your associate, one of your associations, kind of really at their, I think they were on their game on this one. Okay? The other one, we got some guys from Tyson here, and so if I screw anything up here, they can correct me. The Smithfield and Tyson announcements that have come out this winter, I want to visit with them for a minute. The Smithfield announcement was, and I guess we got a representative with Smithfield too. That one didn't surprise me at all. I mean, I thought this was going to happen at some point where they went beyond their company-owned farms. I noticed they were asking them to adopt these sow houses, and then they said you don't have to, but contract extensions are less likely. So, yeah, please do this. And by the way, there's a hammer here, behind my back. Obviously they want this to happen. They've got some incentives to try to get it to happen before 2022. It's not a surprise. I don't think anybody should have been surprised by this. And Smithfield obviously is committed to this on their own farms. Interestingly, everything I hear from their production units is that they've been able to maintain productivity pretty well on these units. They go through some adjustment, but the productivity levels has remained high. The Tyson announcement to me was a much bigger deal. And number one is because it's Tyson. They're the second largest processor. They're the 12th largest producer. They're a successor to IBP, and I never knew of IBP ever backing down from any fight, even if it wasn't worth fighting. And in this case, Tyson's announcement is kind of saying, we're going to back down a little bit on this thing, and I know why they did it. I understand they have a major customer or two that was putting pressure on them, but they've been staunch defenders of producers, and that producers know best. And so this was an announcement that was kind of out of the blue. And plus it was out of the blue because there were some things in it that we haven't seen before. There is the sow housing component, which they never said you can't use stalls. They just said everybody has to be able to turn around. So I guess if you use stalls wide enough they can turn around in, it's okay. But who's going to do that? In addition, they included the thing about euthanasia, blunt force trauma, about pain mitigation, which we don't have any products that are approved of that. And they mentioned in there, they didn't say that you have to do this, and they said that they would fund research on it, which is good. Video monitoring in all barns, I think, is a step that the next day when Walmart released something, you see kind of where some of that was coming from as well. So it was a much bigger deal, one that's much broader. There are no requirements there other than on Tyson's contract farms. The people that raise pigs that belong to Tyson will be required to adopt these over a certain period of time. Other suppliers are encouraged to do so by the statement. But the world is changing, and I think producers have to be ready to change too. And these are a couple of them that have come this year. Okay, key factors for this year. The number one thing that is the big factor for 2014 is costs are lower. I mean, I don't think there's any way you can miss that. We've got some things going on with PEDV that are important, but when you take $30 a head off the cost of producing hogs, it makes the world a lot better place to work in. And I don't think there's much question about that. Even if prices stayed the same, you have a dramatic improvement in profitability. This number has been somewhere in the 78 to 79 range. As a matter of fact, that's the highest number we've seen in a couple of months on this forecast break-even. And I use the parameters out of Iowa State as estimated costs and returns. There are producers out there that are probably $5 to $6 per hundredweight lower than what this one is. So there are some people down in the low 70s here on break-evens for this year based on today's futures market. I said January. I did change this yesterday, and I forgot to change my heading. The February WASDE came out yesterday. Not many changes. The only one of any significance is a 150 million bushel increase in exports. That came directly out of year-end stocks. And so the stocks-to-use ratio at the end of this year was raised just a bit. Still, I don't know exactly how that went down. Well, it went down from 11.1 from 12.4 to 11.1. USDA jacked their price up just a hair, about 10 cents. I don't think it was anything to really get too concerned about, especially when we've been off of $6.89 corn a year ago. This still doesn't look too daunting. So a couple of numbers in here that I think that are important. First, of course, is the large crop. USDA still has a 22% increase in feed and residual usage in their numbers. There's no way that we're going to feed that much more corn. And if you put it in with all the other grains out there, feed and residual use, the number is 17%, and there's no way we're going to feed that much more. We're not going to have more hogs to feed, it looks like, as it turns out. We're going to have fewer cattle on feed all year. We will have some more chickens. We're probably not going to have as many turkeys. And so I don't know exactly where these numbers are coming from, and if they're modeling residual and it's that big, they need to do a better job on some other things. So that one's still a bit of a mystery to me. Obviously, this was driven by excellent corn yields last year, especially in the Eastern Corn Belt, much better than a year before. If we look at usages by category, of course, the growth over the past several years has been in ethanol, but pretty level usage here on ethanol for this year. If we take the increase in feed and residual, add in DDGS from this level of ethanol production, we'd have the highest corn-based feed ingredient number in about 6 years. So obviously some reasons that this is a better situation. Here's the increase in exports, of course, back to a more normal level after dropping sharply a year ago. If we look at where the usage for corn is coming from on the ethanol side, of course, the renewable fuel standard. There's still a lot of dickering going on over the proposed rule from EPA last fall to set the corn-based renewable fuel standard at about 13.5 billion gallons. Probably going to get, Brent and I were talking earlier, he thinks that probably corn's going to get some adjustment to that. But my thought, Brent, is I don't think it's going to get anywhere near the 14.4 that was in the original renewable fuel standard. And so you're not going to force a lot more corn into ethanol out of this than what we've seen the last couple of years. And I think that's true of the future as well. I don't think we're going to do that. World corn consumption and stocks, the highest they've been, here's production and consumption. Stocks are the highest they've been in about 12 years. But if we take that corn stocks figure and put it along with usage to get a stocks to use ratio, you can see we're still not very strong on world corn stocks to use. So that's the reason we still have corn in this 420, 415, 430 range, something like that, trading back and forth. I think we're going to see a lot of corn prices over the next decade between $4 and $5. I think we'll see some down in the threes. We could actually see that this fall with another good corn crop this year based on where stocks are at the present time. We might see some corn up in the $6 range again if we have a dry year. But I think we're going to have a lot of corn in the 4 to 5 range. When I've talked to some folks, we've got break-evens on corn, 430, 420, 430, 440, something like in Iowa. And so when you have a break-even cost level in that range, don't be surprised the price is going to be there. So we'll talk about hog costs in the morning. It's, in just a moment, the same thing kind of going on. One thing that has happened is we've created a lot more supply in the rest of the world. Corn supply, corn production outside of the United States is 50% larger than it was in 2004. Okay, so there's corn available. There was a lot of consternation in some places this last fall, or last summer actually, when we started importing a significant amount of corn into North Carolina. And there were some folks that were kind of up in the air about the United States was importing corn. And I said, that's true only if you think North Carolina is part of the United States. And, of course, the folks in North Carolina took umbrage to that. But I said, but the point is not whether they're part of the United States. The point is that North Carolina always imports corn. They just usually import it from a country called Michigan. All right? Because of our short crop and because of the fact that North Carolina has a port that they can unload bulk ships in, they're importing it from Argentina and Brazil last year. And they are in a position now to do that because the supply of corn is larger outside of our shores. Have we seen the bottom for corn? Well, I think that's pretty likely. I think we saw a spike low back before the January WASDE. We bounced off that. We broke a little bit of a resistance line here at about 440. If you haven't booked corn for the rest of this crop year, I don't think you can go too far wrong, and you haven't left much money on the table at this point. Obviously, there's going to be some things change if we get into planting, but I would start looking to do that. Corn is cheap relative to everything. If we look at corn versus oil, it's cheap relative, as cheap as it's been in several years. Look at corn versus wheat. This says we're not probably going to feed very much wheat this year with the corn relationship. Corn versus soybeans says that soybeans are going to win the battle for acres on those marginal acres. And if you've seen a margin over cash cost computations, that's pretty much true in all of the corn belt at the present time as we go into the spring. So, if corn is cheap relative to anything and you need corn, it's probably a good time to buy it. I mean, that's an economic principle that probably applies when you see this, because the chances are that we're going to bring these back into balance sometime in the next year or two. On the soybean side, a different situation, the same as far as world production and ending stocks and consumption. In fact, ending stocks here are the highest they've ever been. Consumption and production are the highest. Stocks to use ratio among the highest we've seen. And yet we still have beans, right around $13. We've actually we penetrated this resistance line, but we did not close above it here this week. And we've done the same on some support. So you've still got some consolidation in here right around the high 12 range, but you've still got China sitting out here with a huge appetite for soybeans. Now, they've canceled some orders in the last few weeks, and we've read about those, but I still think long-term that the soybean market, they're going to certainly bid for acres as we go through this spring. If we look at the WASDE from yesterday again, I forgot to change that one too. Anyway, hardly any changes here. The same on carryout. A little bit of changes on exports and a little bit more on imports. But that's about all they changed in the WASDE yesterday. The real challenge I think we have is that soybean oil is carrying nothing of the water here on value. We have had just a little bit of a run up in this the last week, but still we've also had meal break some resistance here. And so what do I think is going to happen to meal? Well, I don't think we're going to see any big breaks until we see for sure what the South American crop was. They increased Brazil. They decreased Argentina slightly. The net was a little bit larger South American crop in the WASDE yesterday. But still, I don't know if it's going to be enough to break this hard until we see that actually materializing. And this is going to, with oil here, meal kind of has to stay high in order to support a bean market that will bid away these acres and get acres as we go in the spring. So I'd be more hand to mouth on meal as we go forward here, hoping that a South American harvest will put some pressure on meal prices. The question we have to ask ourselves at this point, are high costs behind us? And number one is, that depends on your definition of high. If you think $75 per hundredweight carcass is high, then no, they're not behind us, because that's going to be a pretty familiar number, I believe, over the next decade. With corn in the 4 range, you're going to have a lot of hog costs between 70 and 80 bucks. And what does that mean for hog prices long term? You're going to have a lot of hog prices between 70 and 80 bucks eventually. Okay? So I think we're going there. It's going to take us a while to get there. Now, I do think that normal crops this year could end up with corn down near 350, somewhere in that range, and beans probably in the low 9s. I wouldn't rule that out at all if we have a normal crop, a good crop again this year. And I'm talking $13.5 billion on corn and right around $3 billion on beans. Okay? Because you're going to build year-end stocks with that kind of crop. And if you do that, then these costs in the 90s on hogs are kind of a thing of the past. So I believe we've moved away from those extreme high costs. I think we're going to see a lot of 70 to 80s. Yields and acres have finally kind of caught up with the forced corn usage and the impact that it had on soybeans. I think one of the keys, obviously in the short term here at least, is what do veg oil prices do. We've had a lot of veg oil available right now, and it would be nice if soybean oil would start carrying a bit more of the value proposition on the soybean side. So, any question on costs? Obviously a lot better situation. I think, again, to recap, hand-to-mouth on bean meal, hoping for some break here on a South American crop. I'd say if you haven't bought corn, you ought to go ahead and get that priced. I don't think you're going to leave any money on the table on that one. For new crop, I'd still wait and see what planting season brings. You're going to be in a weather market again, as we've been every year for the last decade, practically. And you're going to have to see what that happens. But if it looks like it's going to be good, I think we could have even lower costs as we go into next crop year than we have this year. Okay? All right, demand. The macroeconomy, improving. We still got some good things here. Good GDP growth is not stellar, but it's certainly not bad. I mean, the government shutdown kind of slowed us in the fourth quarter. The housing market is still improving. We still have low interest rates. Ms. Yellen is probably going to increase those eventually, but I don't see that happening this calendar year to any significant amount. Job growth was clicking along pretty good in the fall and then kind of hit the skids in December. So not necessarily good there. The wealth effect has been very positive with records on equity markets for those people that have money in the equity markets. Question marks, unemployment still pretty high, down to 6.7%. The U6 rate, which takes into account underemployed and part-time workers, is still over 13. That's down from over 14, but still that's the lowest in about 8 years. Personal disposable income, still a problem, and was a big problem in December. An abysmal December, down 3.4% from a year ago. The average for the year was only up 0.1%. So still no growth in the amount of money that people have left over after taxes to spend on goods and services. And long term, I mean, that's hard to support any demand shifts for very long periods of time, and it'd be nice if we get back to these pre-recession levels of an average of a little over 2%. So it's been a long time. We're now counting 1, 2, 3, 4, 5 years of zero growth on real per capita disposable income. This is a number that we have to turn around. And my concern is that even if we get personal incomes growing from GDP, what do you think taxes are going to do? I'll take up and give you the field, all right? I'm afraid. And so at least they haven't yet, but that would be where the momentum would go. Poultry, red meat and poultry consumption stayed above 200 pounds last year. We thought it was going to drop below it. And now, according to the Livestock Marketing Information Center, forecast to stay about level this year and then grow in 2015. But still, you can see the decline in per capita consumption. And why did that happen? Does that mean people didn't want to eat meat and poultry? No, it means that we just can't afford to bring them as much at the price we used to bring it to them. This is because we produce less than what we did. And here's the downside of that, and that is the prices have been record high. So the downside of it is we have to sell this product for a lot more to consumers. The good side is that consumers have been willing to pay it. Even without more income to work from, we had record high beef prices last year. We had record high pork prices last year. We had record high chicken prices. And we had record high turkey prices, at least in the month of October last fall. I think we're going to see more of that. When we put those together into per capita expenditures, which is very much the same as Ron and Glenn's demand indexes, we can see a tremendous year for the four species together. Ended up almost 4% higher for the year. Here's pork. Ended up almost 6% higher the year, 5.6%. The best year we've had in, matter of fact, it reached the highest, and I didn't put that in here. November and December were the highest levels of monthly real per capita expenditure since 2003. And so real growth here for pork. Beef up 2.8%, chicken up 4%. They had some great months in the fall. Turkey really struggled the first 9 months of the year and then had 3 pretty good months at the end of the year to be up 1.7. So the whole demand picture looks very strong. And if we think about the factors of demand, what determines demand? Income, prices of other goods, okay, because demand is the price of an own good along with its consumption, and taste and preferences. Well, the prices of all meats were higher. There is some difference in relative prices, but in that case, pork gained relative to beef but lost ground relative to chicken. So I would say that's probably a wash for pork demand. Income levels, I already talked about, they weren't higher. So, and meat went up more than goods in general, the inflation rate, meaning that we lost ground relative to all the other things that people could spend money on. So what does that mean? Well, it says that taste and preferences had to be pretty strong in favor of meat. And I come to that conclusion and I kind of go, man, with all the publicity and some of it not very good that we've had, and you're telling me taste and preferences are pretty strong? That's what the data would say. And that's kind of a shock. But it also tells me that we need to be careful because the things that we think are really important to consumers may not be. It doesn't look like they're paying attention to a lot of the things that we worry about. And I'm a little concerned about that as well. So anyway, exports. December was a pretty good month, up about 6.5% from a year ago after a year in which we struggled. I mean, it hasn't been a good year for exports. Not a wreck by any means. I guess the question we have now is, we were on this same trend line from 2004 through 2012, and now are we ever going to get back to it? I don't know that we are. That's a pretty aggressive trend line. Got to remember, we tripled exports during that time period. Okay? So that's a very aggressive trend line. USDA has us at 5.18 billion pounds carcass weight for next year. Given where we were the last 3 months of the year, that might be a little conservative, but the dollar has strengthened. Our prices are going to still be pretty high this year, and so I don't know that that's too far off. If we look at individual markets, I think the real stories here are A, the ascendancy of Mexico. I mean, they got within a breath of being our largest muscle cut market. They've been our largest byproduct market. They ranked second the last 2 years to China and Hong Kong. But in total, they take more pork and pork products than any other market. Now, Japan's still our number one value market, and it will stay that way as long as the gate price mechanism is in effect. But that may go by the wayside if TPP comes along, the Trans-Pacific Partnership, and that would open up Japan to lower-priced U.S. cuts. The other story here is China, and of course we had the two big waves of exports to China, but notice what the trend is. It continues to go up. Not a very good December for China and Hong Kong, but still growing. And the real question in my mind is, do you stay on that trend, or does that trend tilt up a little bit because of the Smithfield-Shanghai deal? I've said all along that I think that this will cause our exports to China to grow faster than they otherwise would have. So I'm going to fall in that camp for 2014 and beyond. We'll see what happens. And the final point I want to make about this one is this kind of green-colored line right here, which is other markets, ones that aren't listed up here individually. And they're led by Australia and several Latin American countries where we've had free trade agreements in the last few years. And they now constitute the third largest destination, if you lump them together, the third largest destination for U.S. pork. Why is that important? Well, to me, it's very important because it really diversifies our export portfolio, and it leaves us a little less vulnerable to this game by the Russians. Okay? And the Russians might be back in our market this year, who knows? But this is life with the Russians. And so doing some diversification of your export portfolio, I think, is strong. So it wasn't a great year, obviously down in exports, but certainly not one that I'm too worried about going forward. All right, let's talk about competitors real quick. Chicken is in a full growth mode. They've been growing the breeding flock pretty substantially the second half of the year. The first half, they would have grown it faster, but they had profitable opportunities to sell fertilized eggs to Mexico because of the avian influenza losses there. But they were up almost 5% for 4 months there, up about 3% in December. They're certainly poised to really start growing output as we go through this year. Egg sets have been up 2 to 3%, placements up fractionally. That's kind of an odd number since January 1, but I think it's going to grow seasonally as we get in the spring. I still expect broiler supplies to be up 3 to 5% this year, and if that's the case, you're going to see their prices be very competitive with pork and beef in the retail case. It's just a function of their biology. They can respond so quickly to these kind of things, and they're going to try to capture market share. On the cattle side, it certainly looks like we're in as much expansion mode as can be allowed in this case. And, of course, pasture conditions much, much better than a year ago. Even these areas of California got some rain this week. And so the demand for cows, we've sold replacement cows at auctions in Iowa for $2,300, $2,400 already this year. And I know they've been expensive here, too. And if we look, I think this is Oklahoma City. Young replacement cows well over $1,000 on a monthly basis, record high prices. And so certainly we've moved to take advantage of these forecast profits in the cow-calf sector. This comes from Livestock Marketing Information Center as well. And, of course, $250 a head will get some attention on this as long as you've got grass to put them on. We have to remember that when we look at heifer retention, here's the cattle report. Beef cow replacements heifer is up 1.7%. That's not as high as was expected. And this is the third year in a row that we've kept about 2% more heifers than a year before. But the last 2 years, those heifers never found their way into the cow herd because we didn't have enough grass for them. This year, it looks like we might, depending on what weather goes on as we go through the summer. But still, tight supplies. If you look at supply of heifers outside, other than breeding heifers, down 5%. Steers 500 pounds and over, down 2.5%. If you look at calves, all calves under 500 pounds, down 3.7%. Put all those together, and the number of cattle outside of feed yards is down almost 3%. The number of cattle in feed yards is down 5%. Okay? It's going to be a tight supply situation all year this year on the beef side, and that means we're going to have record high prices. Now, we've seen cutout values of $238, I think, was the high here on the weekly on the choice, about $236 or $237 on the select. I don't think we're going to stay there, but I would expect that we're going to stay in this $220 range for much of the year on cattle prices, on beef prices. That means we're going to have very good opportunities to sell pork. And here is where something that the Pork Board did last year could really help. I mean, the Pork Board had a campaign last summer of cook it like a steak. they'd been working for several years to do some names that put names on pork cuts that were a lot more similar to beef cuts. I think that the substitutability of pork for beef is probably really good at the retail case, and now the prices are going to support that. In addition, the change of the recommended cooking temperature to 145 with a 3-minute rest plays right into this as well. So I think that was very well timed. I hope it's going to generate some real payoffs this year. But still, we're just excellent. Beef prices are going to be good for pork demand. Long reaction period in the case of beef. It takes a long time for them to change their outputs one way or the other. Excuse me, I forgot to turn that off. But it's really going to be a great opportunity for us in the coming year. Okay, hog numbers. We talked about demand. It's been strong. I think demand is going to continue to be hog strong in the coming year. Hog numbers, we're going to have a few less coming from Canada, largely because the Canadian business has gotten smaller. Now, the country of origin labeling thing is going to possibly work against us this year. There's a hearing next week, I believe, with the World Trade Organization on our rules on country of origin labeling. If the WTO finds against our rules, Canada and Mexico will be free to put retaliatory tariffs on. Now, as I've found out in the last week, the U.S. can appeal this ruling too. So it's a never-ending string of appeals that probably will push this well into 2015 or even 2016 before it comes to a retaliatory tariff. But remember the list of countries that we export to. Now, Mexico, number 1 on total volume. Canada is number 4. And if they start putting tariffs on, it's going to be damaging for our exports, and it's going to put some more product on the U.S. market. So that's really probably the big risk we face on this one in the coming months. Sow slaughter was down almost 6.5% the second half of last year. It was down almost 3% for the year, but the big one is, look at the red line is well below the green line all of last fall. Been pretty close so far this year on sow slaughter. If we look at gilt slaughter as a percentage of bearing gilt slaughter, Ron gathers this information every week. It's been below the 10-year average for virtually all of the last year, which both of those are saying, we're trying to build the stock of females that are out here. And then comes the Hogs and Pigs report in December that said the breeding herd's down 1%. I don't get that, all right? And I can't hardly believe that that's accurate. And then the same report says, but out of that 1% fewer sows, we're going to get 1.3 and 1.4% more litters the next 2 quarters, and I don't get that either. Ron and I have talked for a long time about, the breeding herd is really fun to watch, but if you try to predict anything about supplies off from it, it's worthless. And it really is, because the thing that's driven supplies in the last 10 years has been productivity. It's been productivity in terms of sows, litters per sow. It's been productivity in terms of pigs per litter. Now, so I'm inclined to use the farrowing intentions because they fit with my biases. And they also fit with the data that I think we see on sow retention. Much better than the breeding herd number does at this point. If we look at the December market herds, they were down slightly and pretty close to what was expected, and they've so far proven to be pretty accurate. The critical number in this report was the pig crop, down 0.1%, significantly lower than what was forecast by analysts, and pig save per litter at 10.16, which is 0.1% larger. That's the smallest year-over-year increase in litter size in a decade. We've averaged about 2% growth for the last 7 years, and the December number says that we got no growth at all. Now, it, in my opinion, picked up a reasonable amount of the PEDV losses that we had prior to December 1st. If you look at the monthly average litter sizes, they got smaller from August to September to October to November, and actually those declines were getting larger as the months went along, which suggests to me that we're going to see lower net figures yet for December, January, and February when the March report comes out at the end of March. So this is where the action is, in my opinion, on supplies, is that we're taking pigs out of those. If we look at what's happened to the PEDV cases, let me remind you that that report only took into account anything up to about right here. So, last week's number of positive test submissions at health labs was 265, the highest on record, and that doesn't look to me to be a situation that's getting any more under control. Now, given that, it's very difficult to estimate how many pigs have been lost because we don't know anything about the farms behind these. And we don't know even if some of those samples came off the same farm. We don't know if there are farms out there that have been diagnosed positive, which we think there are, that never had any samples sent into the animal health labs. So we don't know much about it. And it might be a lesson for us. We were talking at lunch today. The Canadians have made PEDV a reportable disease, meaning that if it is diagnosed, we're going to come out and find out where, what has been going on this farm, what kind of farm it is, how many pigs are there, how many pigs are lost. Maybe we need a provision for a new disease that we make them reportable. Right now, the only reportable diseases are those that would impact our exports. Foot and mouth disease, African swine fever, classical swine fever. Okay? Maybe we ought to think about that because it would really help if we had better information on what's happened on this. Number one, it would help maybe slow it down. And number two, it'd certainly help us have some idea of what the market impacts might be. So it's a thought. How many have we lost? We have to remember first that the first cases were in April. The significant parts, pig losses really didn't start until May and June, mainly in the Oklahoma Panhandle. So we didn't see any impact on slaughter numbers until December. And they've been pretty small so far because there wasn't that many cases. If you use the rules of thumb that are out there, for every infected sow you lose 2.3, 2.5. The number I keep hearing is 2.7 pigs. And you multiply times something around 1.7 or 1.8 or 1.9 million sows. I don't know where we are now. You end up with, you could be losing 7 million pigs or so in a 12-month period. And the lion's share of those are still ahead of us in this supply for 2014. They really don't start in earnest until April. And so, that's some pretty significant losses against summer farrowings. This is state data out of the this is Oklahoma data, historical for the Hogs and Pigs report. You can see the September report, they saw nothing. Look what happened in December, though, and this decline in total hogs and in market herd was driven by the stock of pigs less than 50 pounds and the stock of pigs over 180. So there were still losses going on there. The two lessons here are, one, it was dramatic what happened in Oklahoma relative to the diseases last summer. And two, they didn't catch a darn thing in September and they caught it all in December. I don't think that's right. I think it was probably a reporting issue with USDA, but still I think we're getting an inkling of what this is going to do to inventory numbers in the larger country later on. So one of the responses has been, let's make them heavier. We don't have as many pigs, we're going to put more weight on them. And so the pigs have gotten extremely heavy. They've been running over 6 pounds above year ago since last fall. They're not backing off at all yet, which is kind of normal for a seasonal pattern, but man, these are really high levels. And this is the producer-sold pigs. If you look at the packer-owned pigs, they're even heavier, and largely, at least in December, that was driven into January, that was driven by Seaboard trying to make up for lost pigs, but the folks at Smithfield and their supply systems in North Carolina and such have lost a lot of pigs as well. And so we're going to see some very, very heavy hogs as we go through this year that's going to make up for a decent amount of these pig losses. I don't know if it'll get all of them done or not. Here's where we were in September. Obviously, our fall slaughter came in significantly below where we thought it was going to be. I think the only conclusion on that can be that USDA missed some liquidation the fall before when corn prices went up and just never caught it in the pig reports. Those hogs just weren't there, and USDA kept staying with that. If we look at the December report, here's actual slaughter, and we've had some disruptions due to cold weather and such, but so far those numbers are very close from December 1 on. Those numbers are very close to what the report would have suggested, within 1%. And so I would say it's been okay so far. If we look out into the future, what do we think is going to happen? Well, our predictions are for shorter supplies in the spring, and I didn't put the new graph in here. We have actually rolled these third and fourth quarter forecasts back significantly. At the time, I had no impact on litter size in this spreadsheet. I've now got down 1% on litter size as we go through the rest of the year based off PEDV, and so we're going to have significantly lower supplies. This is, that's a weight chart again. Pork cutout value has come up pretty dramatically this spring. I think it's been helped along by beef. We've had an increase in packer margins, and of course, packers will tend to go and bid a little more for hogs when that happens. And we have seen a little life in the hog price, but it's been a bit disappointing. Still, if we take this normal kind of seasonal run-up here, you're going to take these animals up into the $100 range or so in the summertime. I think we'll see significantly better performance this spring than we saw last spring when we had the Russian news and the Chinese ractopamine news that were hurting hog markets. I think we're going to have a big improvement there. We expect much higher prices in March, April, with summer highs in the 105 to 110 range on national net negotiated. If we look at where futures were as of yesterday, put the prices on top of that same cost curve I showed you a while ago, profits for 2014 at $31 per head. Now, those aren't forecast by Steve Meyer's forecasting model. Those are forecast by the futures prices as of yesterday. So you don't have to just believe Steve. You could actually go out. If you had production parameters like this Iowa State set, you could actually go out and lock in those profits for this year. $31, best since 1987, and the third best ever, okay, in our data set that goes back into the 70s. So a pretty dramatic situation. Here's the changes that we've made on our forecast. I have LMIC, Ron and Scott Brown's forecast here, Iowa State. In defense of them, I don't think they've gone and they haven't backed off of their earlier forecast yet. I don't think you've changed anything yet, have you, Ron? I did change mine this week and backed off of these third and fourth quarter slaughter, which would put me significantly lower than where some of the others are. I think as the data start adding up. Now, I also think that we're going to make up for most of that reduction in numbers in weights. So I've got pork production very close to last year's level as we go through 2014. Forecast for prices, I'm still in the upper 90s for the summer on quarterly averages. Here's where the futures were as of yesterday. And so I think there's some opportunities to lock in profits for hogs here relative to where the fundamentals say cash hogs are going to be. The last thing I want to talk about is, this is one of those I've been crying wolf for a couple of years and it hadn't come true. But I'm going to stick to the old economist thing. If you say the same thing long enough, it'll be right eventually. Packing capacity is going to be a problem someday. I thought it was going to be this past fall, and the corn prices 2012 fixed that. And I said, well, then it's going to be next fall, and PEDV is going to fix that. But eventually, we're going to need another packing plant. Now, I talked to some packers, and some of them say, oh, no, don't worry, we got plenty. And I say, where? And they go, don't worry, we got plenty. And so, when I add it up, and I do this survey usually every spring, and I did it last spring, and the numbers I came up with, we've got enough for now, but if we take, let's say we put 2 to 3% more sows in, a very reasonable thing with $30 profits, and we return to a 2% growth rate on litter size, a very reasonable thing, we'll figure out how to handle this disease, I think. And so you do that for a year or two, and you've got an increase of 5, 7, 8, 10, 9% pigs. And if those come disproportionately in the fourth quarter as normal, we don't have enough place to kill them. And if you stuck a shovel in the ground today, you wouldn't be killing a hog in that plant for 2 years. So what do we do about it? Well, number one is we remain aware of it. So you factor that in your growth plans as you decide what you want to do on your farm. We hope that the packers will be looking at this as an opportunity, and someone will say, we need to build another plant at some point, even though for them to build a plant usually means they give up margin for a couple of years because it really changes the competitive nature. But we've got to match these at some point, and I think we're still down from the pre-country of origin labeling days. We're down a major plant. Sioux City is gone. All right, we've replaced some of that capacity with tweaks at the other plants, and we could double shift some plants, But even that takes construction in most cases, and so we got to get started. So, closing thoughts. Lower feed costs are going to drive some expansion, especially for chicken in the short run. I think we're going to lay down some sows for sure with these kind of profits. Demand is good. Macro conditions are improving. It certainly looks like preferences for meat and poultry are pretty strong. I'm kind of amazed that I come up with that conclusion, but I am. Beef supplies will be tight through 2015. High prices and opportunities for competitors. Chicken, much more competitive. Hog supplies, certainly lower due to PEDV. We're going to have less price advantage in the marketplace, more profits. The inelastic nature of demand means that total revenue for pork producers may actually go up this year in spite of PEDV losses, because a 1% decline in supply gives you a more than 1% increase in price, and there's enough here to have market effects in this case.